So I get
Hello, James. This is Top Gun Bobby, longtime listener, first-time caller. Just wanted to ask about the risks of the 90-10 policy with dividend calls in low interest rate environments. Thanks for your answer.
Okay, so the risks of the 90-10 policy and dividend calls. A 90-10 policy, when he asks about that, that means 10% goes to base premium, 90% goes to paid up additions, also known as cash value. What we see in the first year with a 90-10 policy design is we can see up to 90% cash value in year one. That is typically considered the optimal design. Depends on which insurance carrier you're going with. An insurance carrier like Mass Mutual and Guardian, we can get you that 90-10 design. One of the Mass Mutual products, which is a little bit differently, little lower cash value long term, but we can start it off with a little higher cash value in year one, up to 95% I've seen. So that one's a good opportunity as well. But a company like Penn Mutual, 80-20 will be the best design that we can do. Now, the way we get that design is by blending term insurance with permanent whole life insurance. Term insurance is cheaper. It's a cheaper way. It's a lower cost way for us to get a higher death benefit, which allows you to stuff more money into the policy quicker. And that gets your cash value and your break even all sooner than it otherwise would be. A regular whole life design that doesn't have any term blend might take you 10 or 15 or 20 years to break even. Whereas with a nice blend of term insurance, as much as we can get that break even period to 3 or 4 or 5 years or 6 years. Depends on the company, depends on the health rating, of course. So that's a really nice design, but are there risks associated with that? There are a couple of risks that are technically there, but they're very minor and generally not something we consider much. One of those is term insurance. We're using an annual term insurance to blend with it, which means potentially the cost of this term insurance can change year to year as the cost of insurance changes in the overall environment. Now, one of the nice things and risk aversions that whole life provides you is a set death benefit. When you purchase that policy, you know what the cost of that insurance is going to be. I didn't mean a set benefit. I meant a set cost of insurance. You know what that cost of insurance is going to be from day one in order to meet that death benefit that you're purchasing. When you do term insurance into the mix, term insurance does not have those same guarantees with it. So, if you get term insurance that's designed to be around in 20 or 30 or 40 years, depends on how long you're planning on having this policy, you do run a risk of seeing those costs change. So an example of when that might possibly happen is, let's say there's a major pandemic and a lot of people start dying prematurely. Not like we have right now. It's not an unheard of amount that totally screws up all the actuarials of the insurance companies, but I'm talking a bad one that does screw up all the actuarials. So the insurance companies will have to revisit all the costs of their insurance and redo those in order to accommodate the new mortality rates that they actually see happening. So if that were to happen, you could see the costs change on term insurance policies, but you wouldn't see those costs change on the whole life because you're already locked into a contract. Now, why don't we worry about that too much with the policies that we design? Couple of reasons. One, with a company like Guardian, we design the term insurance to get replaced with permanent paid up additions, which is whole life insurance. And that happens as quickly as 7 years. The longest it can take is 15 years. Well, 15 to 20 years. I have seen a couple that stretch out past 15. But that's generally the longest I've seen my ability to be able to extend that term insurance before extra cash that you pay into it totally burns it off. Now, that's with an optimal design. If you actually fund it lower than max funding, that term insurance can stick around longer. But if something happens, cost of the term insurance changes, we can always reduce the cost of insurance. We can always reduce that term insurance that's blended into it. It doesn't have to be there unless you're max funding this policy and you need it to be there. So if you are max funding it, it's not going to stick around for all that long. The other things to consider is, so other companies, Mass Mutual, we can get it to extend out longer. That one we can have that blend extend out 30 or 40 or even 60 years. Just know we can adjust these down the road. So as long as you're funding the policy, it might make it a challenge to adjust it and take it off completely, but we can plan ahead. So the term insurance is not going to get jacked up so high that it's going to destroy your policy. It may go up a little bit or a little bit more year to year in a way that makes it less attractive. And we can see that happening. We can prepare for it. So we can make adjustments to the policy while it's in force. So definitely things to consider and not something to really have to worry about having that blend with the term insurance. Now, another risk could be if the dividend option or if the dividend rate changes. So this leads to his second part of his question where he asked about a dividend call. I'm assuming he means where the dividend changes, and it changes in such a manner that it's going to affect whether your policy might become a modified endowment contract. Now, this is possible if the if the dividend rate gets reduced. The amount of paid up additions that you're paying into the policy will be, well, the amount of paid up additions that the dividend that was projected is buying will be less. And some companies like Penn Mutual will not allow you to add in extra money to make up for that. So if we're running a really tight ship, if we have a really strong design that has you contributing right up to the MEC limit and the dividend rate lowers in future years, it's possible that they're going to say, okay, you're not quite in the range where you need to be to avoid this becoming a modified endowment contract. Well, what's going to happen in that case? Well, what's going to happen is the insurance company is going to say, here, you need to take some of your money back. You put too much money in, your policy will become a modified endowment contract if it stays in. And so you'll have the opportunity to fix that. These things don't just happen. It won't just become a modified endowment contract because the dividend rate changed. You will get the opportunity to fix it. That's how these things work. So really the concern about it is overblown in my opinion, and the people that bring this up as something to worry about and as a reason to design it differently with less of a blend, I think it's totally unfounded. I mean, they're asking you to sign up for a policy that has a lot less cash value in year one, like a 60-40 or 70-30 design. That pays them a lot larger commission in year one, and you're doing it on the off chance that dividend rates will change in the future and you're going to ignore the company's request to actually pull out some of that money. Now, what happens if you do pull out some of that money? You have a little lower cash value, kind of like maybe closer to what you would have had you gone with their original design at 70-30 or 60-40. So in my opinion, you're better off start off with the 90-10 design or as close to it as you can, because it minimizes the insurance expense in the policy. We know that that happens because the commission to the agents is reduced. Now, the commission being reduced to the agent as low as we can possibly get it only translates into better cash value for you from day one. And the other I guess the other concern that they point to is insurance companies figure dividend payments a little bit differently when it comes to the different blends. And a 70-30 blend might get a higher dividend payment than a 90-10 blend. But even though you see a higher dividend payment on those illustrations, when you actually look at the cash value, it's still higher in the 90-10 design. You got to check out my buddy Steve Parisi's video. He shows you in detail on the spreadsheets the comparisons of those. So a 90-10 hit, I could do the same thing, but there's not really a reason for me to copy his videos if it's explained really well, and he does a great job of that. So check out Steve Parisi's IBC Global videos on the 90-10 design compared to some of the other designs. They're really great, really great. This was a question asked and answered during one of our Wealthcare Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealthcare Wednesday live streams where you can ask the question and we will answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.